Good evening and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to the third session where we are going to cover the important concepts from the subject of Indian economy. Right? And this particular session is for those particular aspirants who are appearing for the civil services exams Prelims 2026. Now, before I start, I said this is the third session because earlier I've taken two sessions wherein I've covered the topics which are relevant from the macro economy, such as the budgeting concept, the GDP, inflation, etc. And in the second session, I've covered the important topics from the growth as well as development area as well, such as agriculture, financial market, etc. Today is the third and the final session in the marathon series covering the Indian economy. And today I'll be covering the important areas associated with external sector. Now, before I start, here is a very important announcement. Those who are preparing for the civil services exams 2027, they need to have a structured approach. And I know a lot of your friends have started preparing for the next year civil services examination. Once you enroll into our platinum courses, you will get the approach towards how to ace the examination in the first attempt itself, be it in terms of the live interactive classes where you have to keep your cameras on, the weekly test covering the prelims as well as the mains examination syllabus, etc. In this regard, today and tomorrow, the platinum experience sessions are available. Those interested, use the link provided in the description, right? Enroll for the free platinum experience class. Now, before I start, please do let me know that I'm audible and visible for all of you. Am I audible and visible? Okay. Just give me a second. Need to change a setting. Sorry for the interruption. Let's start the session now. So, in this particular session, the areas that I'll be covering will include exchange rate, balance of payments, World Trade Organization, market integration, and foreign trade policy. Right, so these are the areas that I'll be covering in today's session, starting with the important concept of exchange rate. Now, India is an open economy. I'm pretty sure all of you know this. India is an open economy. And what does the word open economy essentially mean? It essentially means there are interactions between India and rest of the world. India and rest of the world. Interactions in the form of imports and exports, interaction in the form of the investments coming in as well as investments going out. Now, all of these particular interactions essentially will require conversion of one currency into another currency. That is, converting the domestic currency rupee into the foreign currency dollar, and converting the foreign currency dollar into the domestic currency rupees. And why do you need this kind of a conversion? A reason is simple. You cannot use the international currency for conducting transactions in the domestic market. You can't use it. For a simple reason, in the domestic market, we allow only the rupee to be utilized. And in the same way, you cannot use the rupees in the international market. Let's say I've imported something from USA. Can I use the rupees for directly making the payment to an exporter sitting in USA? The exporter will not accept it. The exporter will demand payment in the form of the dollars. So in simple terms, please understand, you need to have conversion from your domestic currency into foreign currency and from the foreign currency into the domestic currency. For that particular purpose, there is a market which is called as forex market. There is a market, forex market, in short, foreign exchange market. And in the foreign exchange market, you can basically sell the domestic currency, get the foreign currency. And if you have the foreign currency, you can sell the foreign currency and in return get the domestic currency. That market is called as forex market, and the rate at which, I repeat, the rate at which you basically provide the domestic currency and get in return the foreign currency. For example, in the newspapers, you will come across a statement, $1 is equal to 93 rupees, or $1 is equal to 93.6 rupees. $1 is equal to 91 rupee. What does it actually mean? It actually means if you have $1 in return, you can get 93 rupees. And if you want to get a dollar, then you'll have to spend 93 rupees to get this particular dollar. This is called as exchange rate. In simple terms, how many units of the domestic currency are required basically to be sold in return to get 1 unit of a foreign currency. That is exchange rate. Now, when you talk about exchange rate, how do we determine the exchange rate? What is the methodology to determine the exchange rate? Right? For example, today you come across the statement $1 is equal to 93 rupees. On what basis have you arrived at this particular number? Right? So please understand, there are essentially two methodologies. One is called as a fixed exchange rate, and the second one is floating exchange rate. Fixed exchange rate, and the second one is floating exchange rate. And in the context of fixed and floating exchange rate, what is essentially the idea? In a fixed exchange rate, how much is the currency value? $1 is equal to rupees. How much is the currency value? That is determined and that is fixed. For example, hypothetically speaking, let's say central government will announce $1 is equal to 60 rupees. This is a fixed exchange rate. Do we use the fixed exchange rate in India right now? No, we do not use the fixed exchange rate. Rather, we use the floating exchange rate. And specifically within the floating exchange rate, not purely 100% floating exchange rate, we use a managed exchange rate. In floating exchange rate, it is the market forces of supply and demand. I repeat, market forces of supply and demand that will determine the exchange rate. For example, if there is too much of supply, excess supply of, let's say, rupees in the market, excess supply of any currency will generally lead to what? Lowering the value. Excess supply will lead to lower value of the currency. If rupee supply is very high, then the value of rupee will fall down. If demand for the rupee is very high, then the value of rupee will increase. Right? This is how in the floating exchange rate, the market forces of supply and demand will determine the exchange rate. Now, before I go forward, is everybody okay with the concept of fixed exchange rate and floating exchange rate? Do let me know in the chat section. Is everybody okay with the fixed exchange rate as well as floating exchange rate? Do let me know in the chat section. Can I go forward to the next one? Everybody's okay? Okay, done. Right, so in case of the India's exchange rate system, generally how is it determined? Most of the times we allow the market forces to determine the exchange rate. That is the demand as well as supply of the currencies. Demand as well as supply of the currencies will determine the exchange rate. But please understand, there are certain instances. there are certain instances where there is a sudden appreciation of rupee or there is a sudden depreciation of rupee. Now, I've used two terms, appreciation as well as depreciation. Whenever a currency value, understand the statement now, whenever a currency value goes up, whenever the value of the currency goes up against another currency, if it is in the floating exchange rate, if it is in the floating exchange rate, this is called as appreciating currency. This currency has appreciated. And if the value of the currency against another currency has decreased in a floating exchange rate, we say this is a depreciating currency. Appreciating means value has increased and depreciating means value has decreased. So in the market, when you talk about floating exchange rate, whenever there is a sudden appreciation or sudden depreciation, continuously the value of rupee is either increasing or decreasing. In that particular situation, the Reserve Bank of India, the RBI, will intervene in the market. The Reserve Bank of India will intervene in the market. For what purpose? It will intervene in the market to stabilize the exchange rates. It will intervene in the market to stabilize the exchange rate. And please remember, use the term stabilization. Do not use the term fixing the exchange rate. RBI doesn't fix the exchange rate. RBI rather stabilizes the exchange rate. What is the meaning of it? The RBI will intervene in the forex market in order to stabilize the appreciating currency or the fast depreciating currency, but it doesn't keep a target exchange rate in the mind. It doesn't keep a targeted exchange rate in the mind. It will simply arrest the sudden appreciation or the sudden depreciation of the currency. And this is done because the Reserve Bank of India, please understand, Reserve Bank of India has a very important function to perform. RBI's one of the function is essentially to maintain forex reserves. It is to maintain forex reserves. RBI holds all the forex reserves in India. It is a custodian of the forex reserves. And whenever there is, right, let's say a sudden outflow of the dollars, which will lead to depreciation of the rupee, because the foreign investors, take the current affairs example, the foreign investors will have rupee investments in the Indian market. Now they are worried about volatility or they want to earn more interest by investing outside India, etc. So what they will do is they will start selling the instruments in the market, take the rupees, go to the forex market, start converting rupees into dollars, take the dollars, go out of India. Currently, that is exactly what is happening because of the crisis in West Asia. As a result of all of this, what will happen is rupee will start to depreciate very fast. Rupee will start to lose value. Its supply has increased in the forex market. It will start losing value. RBI cannot allow this kind of uncontrolled, I repeat, uncontrolled loss of value of rupee against the dollar. So what does RBI do now? RBI essentially will take the money from its forex reserves, sell these particular dollars in the market, and supply increases of the dollar, and in return, RBI will start purchasing rupees from the market, thereby reducing the supply of rupees, increasing the supply of dollars. So please remember, RBI will perform the function which is exactly opposite of what is happening in the market. I'll repeat the statement. RBI will perform a function which is exactly opposite to what is happening in the market. That's the reason I'm saying RBI will stabilize the exchange rate. RBI does not determine the exchange rate. And if you say RBI determines exchange rate, then essentially you're saying RBI is fixing the exchange rate, and we do not follow fixed exchange rate mechanism. We follow floating exchange rate mechanism. Right? So RBI will use the forex reserves, will supply the forex reserves, ensure sufficient dollars are available so that the value of the currency will be stabilized. Right? So please understand, There are two technical sets of terms here. In the context of floating exchange rate, we use the term appreciation and depreciation. In the context of fixed exchange rate, we use the term revaluation and devaluation. Revaluation, devaluation essentially means value of the currency is adjusted against another currency but by government. But by government. So when value of one currency is increased by the government against another currency, we use the term revaluation. And when value of one currency is decreased by the government against another currency, we call it as devaluation. So in the context of fixed exchange rate, revaluation, devaluation. In floating exchange rate, appreciation as well as depreciation. And in context of India, which is the methodology we use, right now we use floating exchange rate, but again I'm repeating this, it is not completely floating exchange rate. It is managed floating exchange rate. In fact, IMF calls this methodology as a dirty float. IMF calls what we do, that is what RBI does, as a dirty float. Is everybody okay with the discussion so far? Please do let me know in the chat section. Is everybody okay? So I've covered fixed exchange rate, floating exchange rate, and managed exchange rate. Why does China devalue the currency? China will devalue the currency, or there is an allegation that China will devalue the currency for a simple reason. China is a net exporter. China is a net exporter. And just when you go for a devaluation of a currency, what is the impact of it? The impact is exports will become more competitive and imports will become more costlier. And if you're a net exporter, that will work in your favor. That is exactly what is the allegation of multiple other countries against China. That is basically China goes for devaluation. What is dirty float? Dirty float basically means the intervention, central bank interfering in the market. When you say a floating exchange rate, you should allow only the market forces, but the central bank will intervene. That's the reason it is called as a dirty float. Now, these are the methods which are generally used to determine the exchange rate. What is the role of Reserve Bank of India? I said Reserve Bank of India is involved in stabilizing the exchange rate. Stabilizing the exchange rate. And please understand, whenever RBI will interfere in the market to stabilize exchange rate, there is always a danger. There is always a concern. The concern is, let's imagine, RBI will basically sell rupees in the market and purchase dollars. Listen to me carefully. Let's say RBI is interfering in the market and RBI is basically selling the rupees and purchasing the dollar. Why is RBI doing this? RBI is doing it because the supply of dollar in the market is too high. Imagine a lot of foreign investors have brought money into India. Supply of dollars is very high. So the dollar is continuously depreciating, rupees continuously appreciating. Now what will RBI do? RBI will basically, start selling rupees so that the demand of the rupees is met in the market and start purchasing dollars from the market. Now as a result of this, can I simply say supply of rupee in the market, in India's market has increased. Supply of rupees in India's market has increased. And when the supply of rupee increases, is there a danger of inflation in the economy? Is there a danger of inflation in the economy? Of course, yes, there is a danger of higher inflation because the money supply is higher. Now, what does the RBI do? Listen to me carefully. RBI cannot allow the exchange rate to continue to perform this way. That is, RBI cannot allow dollar to continuously depreciate, rupee to appreciate. It will have a larger impact. If RBI will interfere, rupee supply increases and it will cause inflation. That is also a danger. So what does RBI do? RBI will continue to sell rupees in the market. But at the same point of time, RBI will conduct open market operations. RBI will conduct open market operations. And what does RBI do under the open market operations? RBI will sell the government bonds and take away the rupees from the banking sector. So, on one side, rupee supply has increased, and on the other hand, rupee supply has decreased. This is exactly what is done by Reserve Bank of India in order to maintain stability in the exchange rate, but at the same point of time ensure that its participation in the forex market is not going to add to inflationary pressures in the economy. This methodology is called as sterilization. Is everybody okay? This methodology is called as sterilization. Right? That is essentially, on one side, conducting operations in the forex market, but at the same point of time, conducting OMO in order to ensure that the impact of its intervention in the forex market is not felt in the other parts of the economy. This is called as sterilization. Right? This is the important role of Reserve Bank of India. Right now, what are the factors which will influence exchange rate? Right? What are the factors which will influence exchange rate? Let's understand one by one. First one, interest rates. Right? How interest rate will have an impact on the exchange rate. Let's say India will increase, or in the Indian market, there is increased interest rates. Indian market will offer higher interest rates. If you're a foreign investor, you will invest in India. Now that investment will earn you more interest rates. Now, when the interest rates are higher, the foreign investors, the foreign investors will be attracted towards India. They will increase their investments in India, and that will essentially lead to more inflow of dollars. It will have an influence over the exchange rate. Very simple idea. It will influence the exchange rate. Right? So this is one. Interest rates will influence exchange rate. I'll give you one more example in this context. There is something called as Fed tapering. There is something called as Fed tapering. What is the idea of a Fed tapering? Fed tapering is nothing but the monetary policy that is used by Federal Reserve. Monetary policy used by Federal Reserve. Now, under this particular monetary policy, what happens? Imagine there is a recession or a slowdown in the economy of USA. The central banker, in order to promote recovery, in order to promote growth and recovery, will essentially reduce interest rates. And when the central banker, that is a Federal Reserve, central banker of USA is called as Federal Reserve. So when the Federal Reserve will reduce the interest rates, money supply increases, interest rates will be lower, more borrowings will be done, the employment creation will start, demand for the goods and services will happen. There is a recovery that is promoted in USA. Now, once the recovery takes place, once the recovery happens, the Federal Reserve now realizes that there is too much of money supply in the economy. There is money supply. In addition to that, people are earning salaries now. Their wages have increased, and all of this will contribute to higher demand for goods and services. Now, what does the Federal Reserve do? The Federal Reserve will start to increase the interest rates. Will start to increase the interest rates. And when the interest rates are increased, when the interest rates will start to go up, essentially it will basically start attracting investments into USA market. Basic idea. If the interest rates are higher, investors will earn more amount of money, right? That is their rate of their earnings will be much higher. So foreign investors will start to move the investments back into America, and they will start to earn more. But at the same point of time, that is when Fed tapering is done in USA. Fed tapering means what? Increase the interest rates. And when they increase the interest rates, money supply will go down. This is a tapering. Tapering means reducing. Tapering means reducing the flow. So increased interest rates will attract foreign investments. Now, these foreign investments, imagine, will go from India. From Indian market, foreign investors will withdraw their money, will take the money and start investing in American market. So at one side or in one side, there is a capital flight. In one side, there is a capital flight, that is from India, there is a capital outflow, capital flight. So, with the change in the interest rates, money will go out of India. Will that influence exchange rate in India? Of course, yes. So, everybody is okay, right? So, will the change in the interest rate have an impact on the exchange rate? Of course, yes. That is the first one. Second, inflation. How inflation will influence exchange rate? Whenever inflation rates are very high, please remember, whenever inflation rates are very high, generally it will hurt that particular economy. It will hurt that economy. Any country with very high rate of inflation, the real interest rates in that particular economy will fall down. A lot of times investors will be worried about investing in such market. Rather than investing in that particular market, investments can be taken outside into another market. And whenever the inflation rate is very high, it will also have an impact on how much goods and services you can purchase within the domestic market, how competitive your product will be compared to a product imported from the external market. Let me give you a very simple example here. Imagine, imagine India will experience a much higher rate of inflation compared to other countries. Inflation rate in India will be much higher. Again, I'm saying imagine. So when the inflation rate is very high, can I simply say the market price of the goods will also become very high? So compared to the products which are imported, I repeat, compared to the products which are imported, now your domestic currency will be having lesser purchasing power in case of the goods which are produced in the domestic market compared to goods which are imported. I'll repeat the statement. Your currency, that is, let's say 100 rupees, with the 100 rupees, now you will be able to purchase lesser goods which are produced in India compared to the goods which are imported. Your currency will have more purchasing power in the context of imports rather than what is produced in the domestic market. That will have an impact on imports as well as exports. That will have an impact on exchange rate. Right? So the inflation rate will also influence exchange rate. Everybody is okay? Please focus on the discussion. Do not worry about the PPT. Let the session be over. After the session is over, you will get the PPT. That is a promise from my side. You will get the PPT. Please focus on the discussion. Third one, government debts. Government debt. Will the government debt have an influence over the exchange rate? Of course, yes. The government debt, whenever it is higher, it means the demand for the money in the domestic market, demand for the money in the domestic market will be higher. Whenever the demand for the money is higher, right, the supply of the money will also be higher because the government doesn't simply borrow and keep the money with itself. Government will borrow and start spending. Money supply increases. It causes inflation. It will have an impact on the inflow of the investments or inflow of the dollars as well as the outflow of the dollars. That is how government debt will also influence exchange rate. Next, imports as well as exports. Of course, yes. Imports as well as exports. If the imports are very high, then you need to convert your rupee to dollar. If the exports are very high, then you will get more dollars. You will convert dollar into rupees. Right? So imports as well as exports will also influence the exchange rates. And finally, different types of deficits in the balance of payment. Different types of deficits in the balance of payment. For example, in the balance of payment, you will have a deficit such as the trade deficit. You will have deficit such as current account deficit, CAD, current account deficit. Trade deficit essentially means you are importing more compared to exports. The value of imports is greater compared to exports. Now, when there is a trade deficit, it simply means from India, there is a net outflow of dollars. I'm only talking about the trade, by the way. When you say trade deficit from India, there is a net outflow of dollars, which means in India's forex market, now there will be supply of rupees and demand for dollars. Rupee value will start to decrease, dollar value will start to increase. This is how deficits in the BOP will also influence exchange rates. Right? There are different types of deficits. Let me cover the BOP. There we can establish the connection. Please do let me know. Everybody is okay with the discussion so far? Please do let me know. Everybody is okay with the discussion so far. Can we go forward? Right, so far what we have covered. How do we determine the exchange rate? What is the role of Reserve Bank of India in the forex market? What are the factors which will influence exchange rates? Now, what are the other important concepts associated with exchange rate? Important concepts. One is called as nominal exchange rate. Second one is real exchange rate. Third one is nominal effective exchange rate. And the fourth one is real effective exchange rate. Let me explain them one by one. What is the basic idea of a nominal, real, etc.? Let me explain one by one. Right, the nominal exchange rate simply means what is the exchange rate right now in the market. In the market right now, how many rupees do I have to pay in order to get $1? That is called as nominal exchange rate. Right, and the nominal exchange rate is very volatile. Every day you are observing rupee value will start to fall down or pick up, fall down, etc. So nominal exchange rate, it is the exchange rate right now in the market regarding how many dollars you will get for, right, let's say rupees that you're paying. Second one is real exchange rate. Real exchange rate. Now, before I go forward, please listen to me carefully. Whenever you come across nominal and real, the difference is in nominal, there is absolutely no adjustment with inflation. There is no adjustment with price levels. That is, whatever is the difference in the price levels amongst the member countries or amongst the countries, there is absolutely no adjustment done. Sir, what do you mean by adjustment? Let's say you want to purchase a good, right, using your currencies from the USA market. Now, don't you think what is the price of the good? What is the price of the good in USA, which is mentioned in dollars, will also play a very important role in whether you are importing this or not. What do I mean by this? Let's say you want to purchase, right, a Starbucks coffee. In USA, the Starbucks coffee will be, let's say, $5. Whereas in India, the same Starbucks coffee, for the same volume of coffee that you purchase, you will pay, let's say, 200 rupees. So when you want to import and export, please understand, when you want to import and export, it is not just the nominal exchange rate that will be very important for you. In addition to the nominal exchange rate, you should also know what is the price levels of the products in two different countries like this. Please let me know now the answer to this question. Imagine the exchange rate is $1 is equal to 90 rupees. Here is my question to you. Exchange rate, nominal exchange rate is $1 is equal to 90 rupees and the Starbucks coffee in USA is worth $5 and the same Starbucks coffee in India is 200 rupees. Will you import this particular product into India? Think of it. Will you think of importing this particular product into India? It doesn't make sense. Right? The basic argument is it doesn't make sense. Why? If you are applying the exchange rate, nominal exchange rate of $1 is equal to 90. For $5, now you will have to pay how many rupees? 450 rupees. 450 rupees. So a Starbucks coffee which is available at 200 rupees in India, if you import it, you will have to pay 450. So what is the logic or what is the point of simply importing a product rather than importing? What makes more sense now? It is making more sense to export the product to USA. So the point I'm trying to make here is very simple, right? Very simple point. Most of the times we are focused only on the nominal exchange rate. But in reality, what happens is beyond the nominal exchange rate, there is also a real exchange rate. And that is more important. And what is a real exchange rate? It is basically an exchange rate to compare the price levels, or let's say the competitiveness of India's products with other countries' products. This real exchange rate will provide you a comparison between what is the worth of Indian product with, let's say, an American product. How much is the worth of India's product with UK's product? How much is the worth of Indian product with Japanese product, etc. So in nominal exchange rate, you simply compare currency with currency. But in real exchange rate, you as usual take the value of the currency. But along with the value of the currency, you also take into consideration the price levels of the products in two different countries. Is everybody okay with this idea? Please do let me know. So in terms of understanding whether should we import or export, it is not just the nominal exchange rate. It is real exchange rate that is more important. But there is one more complication here. What is a complication? The complication is that when you trade with countries, when you're trading with countries, you don't just trade with only USA. You do not trade only with UK. You do not trade only with Japan. You are trading with group of countries. Is it okay? You are trading with group of countries. And that is the precise reason. Right now, right now what we are doing? One currency with another currency. One country's product with another country's product. Instead of comparing country with only one country, that is Indian rupee with a dollar, Indian product with American product, now we calculate two more indices. I repeat, indices. That is nominal effective exchange rate. Nominal effective exchange rate. One is a nominal effective exchange rate and the other one is real effective exchange rate. Real effective exchange rate. I'll start using the short form of this, NEAR and REAR. NEAR as well as REAR. Now before I start, here are certain important points. These are two complicated concepts. I'm being very frank with you. These two are bit complicated concepts. You do not have to worry about the calculation that is involved in arriving REAR as well as NEAR. This is point number one. Point number two. What is common between both of them? What is common between both of them? RBI publishes both of them. This is common. Second thing that is common is RBI publishes both of them in the form of index. In the form of an index. What is the meaning of an index? Index is basically a representation of something in the form of a number. You want to represent something in the form of a number, that will be basically the index. For example, all of you know the concept of inflation. Correct? All of you heard about the inflation. What is inflation? Inflation is an index number. Inflation of let's say 4%. What does it actually mean? We are representing a number to basically show that the price levels from last year to this year have increased by 4%. If I say inflation is 8%, from last year to this year, the prices have increased by 8%. So in order to represent something, in order to compare something, we use numbers. That process is called as indexing. So both NEAR and REAR are indices. Both of them are indices. And when you say index number, obviously there has to be, right, a base year. Base year for the calculation of these indices is 2015 and 2016. So these are the common things between both near and rear. But what is fundamentally the idea of a near and what is fundamentally the idea of a rear? In near, we are comparing the value of the domestic currency against basket of foreign currencies. I'm repeating the statement. In near, we are comparing value of the domestic currency against basket of foreign currencies. Why should we take a basket here? We must take a basket for a simple reason. We are not conducting trade only with one country, that is USA. We will conduct trade with UK, with European Union members, with African countries, with Middle East countries, with other countries in Asia. So there are different currencies which are used by different members. So when there is a fluctuation in each of these particular currencies, it will have an influence over imports as well as exports when they conduct the trade with India. That is the precise reason in nominal effective exchange rate, what we are trying to find out is simple. Value of the domestic currency against the foreign currencies, but which are taken in a basket. And there is one more very important term here. That is, when you take the basket, you also consider a trade weight. You also consider a trade weight. What do you mean by trade weight here? Let's imagine India is conducting trade with USA as well as UK. Just to make it very simple. Imagine India is conducting trade with USA and UK. What is the currency of USA? Dollar. What is the currency of UK? It is pound. Now, if 99%, I repeat, if 99% of the trade is conducted between India and USA, very small percentage, I repeat, very small percentage of the trade is conducted between India and UK, then don't you think whatever is the change or the fluctuation in the value of a pound, whatever is the fluctuation in the value of pound, the impact of that on the trade will be minimal. The impact of that with the trade on India or with the trade in India, right, that impact will be minimal. So that is the precise reason. What we also do is we take a basket of currency. Along with that, we take essentially the trade weightage as well. So comparison between one currency, that is Indian rupee, against basket of currencies along with a trade weight, that is called as nominal effective exchange rate. Nominal effective exchange rate. And simply memorize this now. Whenever near increases, whenever the near increases, what does it actually mean? Whenever the near index increases, let's say last year the near index was 120, this year the near index is 130. What does it actually mean? It simply means, please remember this, if the near index goes up, then the value of the rupee against the basket of currencies is changing. Value of rupee against the basket of currencies is changing. How so? If the index number goes up, then the value of the rupee is appreciating. Then the value of rupee against the basket of currencies is appreciating. And when the index number goes down, the value of rupee against the basket of the currencies is depreciating. Is everybody okay with this? Please do let me know. Is everybody okay with this? Right? Again, we can go through the calculations, etc., but all of that is not required for the UPSC GS paper 3. That is required only for optional papers. So when the index number goes up, right, sir, what is the meaning of it? Let me give a basic idea just to make you understand one simple example. Imagine 1 rupee is equal to $10. Again, imagine 1 rupee is equal to $10. If the value of 1 rupee becomes is equal to $11, if I use the concept of indexation, 1 rupee is equal to 10, I will basically index it to 100 units. 1 rupee is equal to $11 now will become 110 units. Are you able to understand? If I index what is 1 rupee is equal to $10 is equal to 100. This is indexation. Then when 1 rupee becomes $11, it will automatically become 110 number. When 1 rupee is equal to, let's say, $13, this index number will increase from 100 to 130. So when the index number is increasing, on one side rupee is there and on the other side dollar is there. So when the index number is increasing, value of rupee is increasing. Right? Value of rupee against the dollar is increasing and the value of dollar against rupee is decreasing. So when the near index increases, it simply means rupee is appreciating. And when near index decreases, it simply means rupee value is depreciating. Is everybody okay with this discussion? Everybody is okay with the near number here or near index? It is published every month by Reserve Bank of India. In fact, RBI has two baskets of currencies here. There is one basket having a very limited number of currencies, 8, and there is one more basket having 40 currencies. So RBI will keep on publishing every month what is the index number near. Then there is a REER as well. Then there is REER, real effective exchange rate. Real effective exchange rate essentially is, again, remember the concept of inflation or adjustment with price levels. When you say nominal, no adjustment of price levels. And when you say real, there is adjustment with price levels. So when you say real effective exchange rate, it's the same idea. Here, the value of currency, Indian currency against the basket of foreign currencies is determined after adjusting for price levels. After adjusting for price levels. Is it okay? After adjusting for price levels. That is essentially what is the price level of a product in India and what is the price level of a similar product in America. What is the price level of a similar product in UK? What is the level of price in India against, let's say, Japan, South Korea? The price levels are considered. So when you adjust the value of rupee against a basket of currencies along with price levels, adjusted with price levels, that exchange rate is called as real effective exchange rate. That exchange rate is called as real effective exchange rate. And when the real effective exchange rate, when there is a change, when there is an increase or decrease, it will have an impact on imports as well as exports. Because I hope you remember earlier when we did the calculation between Starbucks coffee in USA and Starbucks coffee in India. Right? And when you compare the price levels, that is real exchange rate. And when the real exchange rate will become volatile, will keep on increasing or decreasing, it will have an impact on imports as well as exports. Done? So these are the two indices, NEER as well as REER. So this is basically the important concepts within the idea of a exchange rate. Now let's go forward. Next concept I want to discuss is the balance of payments. Balance of payments. What is the basic idea of a balance of payments? Balance of payments is a systematic record of all the import as well as export transactions. I'll repeat the statement. Balance of payments is a systematic record of all the import as well as export transactions. What is the meaning of it? India is an open economy, which means lot of transactions will bring in dollars into India and lot of transactions will take out dollars out of India. Right? Dollars will come into India, dollars will go out of India. That is basically the idea of an open economy. Multiple transactions are conducted between one country with the rest of the world. For example, let's say you will export something to USA. Dollars will come into India. You will export services to UK. Dollars will come into India. right? You will go to USA and send remittances back to your family. Dollars will come into India. The foreign travelers, foreign tourists will visit India. Dollars flow into India. These are the transactions which will lead to inflow of dollars. But at the same point of time, let's say you go to travel USA. You will take out dollars from India. Indian investors will invest, let's say, in the UK market. In the USA market, dollars are going out of India. So transactions which are leading to inflow of dollars, transactions which are leading to outflow of the dollars, all these transactions are recorded by Reserve Bank of India. I'll repeat the statement. All these transactions between India and the rest of the world are recorded by Reserve Bank of India. And this record is called as balance of payments. Everybody is okay? This record is referred to as balance of payments. Right? So this is point number 1. Point number 2. How is the balance of payments prepared? Right? Listen to me carefully. According to International Monetary Fund, according to IMF, the balance of payments is supposed to have 3 accounts. One is the current account, second one is the capital account, and the third one is the financial account. But Reserve Bank of India, traditionally or historically, the Reserve Bank of India has been publishing the balance of payments having 2 accounts. One is the current account, second one is the capital account. Whatever transactions are supposed to be mentioned as a financial, these will be clubbed into capital account. So there will be 2 accounts. One is the current and the second one is the capital. What is the fundamental difference between the current and capital account? In the current account, all the transactions that will influence national income, that will contribute to income, all these transactions are kept under the current account. Whereas any transaction that will change the assets and liabilities, it is recorded under capital account. It is recorded under capital account. For example, please listen to me very carefully now. Imagine this is the record of the transaction. On one side, I will write revenue. Revenue means what? Dollars coming into India. And on the other side, I will write expenditure. That will mean dollars flowing out of India. So there are 2 sets of accounts here. One is the current account and the other one is capital account. Current account and capital account. What are the examples? Let's say you will export goods or services. You will export goods or services that will bring in dollars into India. You will import goods and services that will lead to outflow of dollars. In addition to this, remittances coming into India, remittances going out of India. Remittances coming into India, remittances going out of India. What do you mean by remittances here? Remittances essentially refer to flow of money. Flow of one-sided, right? One-sided money like this. For example, let's say a software engineer from India will go to USA, will get located in the USA, will earn money, that is a salary in the form of dollars, and will send the dollars back to the family in India. That is remittances. We call it inward remittances. And in the context of inward remittances, please remember this. India is the largest inward remittances receiver. Largest inward remittances receiver in the global market. This can be asked in the prelims examination. India is the largest in terms of accepting inward remittances. How much? Around $130 billion now. World Bank annually will publish the report. According to these reports, India has been receiving more than $100 billion for many years now. And according to the latest data, it is more than $130 billion. And out of these inward remittances, a large chunk of it, the highest chunk of it, comes into India from USA. Highest chunk of it comes from USA. Then there are Middle Eastern countries such as UAE. This is important for a simple reason. Historically, when you look at the remittances, historically, large chunk of the remittances used to come from the countries which are falling in the West Asia or Middle East. But in the recent times, there's a change in the pattern. There's a change in the pattern. More and more remittances are coming from the developed economies. More and more remittances are coming from developed economies. And this is important for a simple reason. Compared to the kind of jobs that the Indians will get in the Middle East, the kind of or the quality of the jobs in the Western economies is much better. They will use the term blue collar, white collar jobs, right? Much more stable jobs, much more qualitative jobs, right? Let's say jobs with better packages or better pay, etc. This is essentially the change in the remittances pattern that has been observed in the last 2 years in the context of India. Let me continue. Remittances coming in, remittances going out. There is also, right, let's say investment income. There is also investment income. For example, let's say you have invested money. You have invested money, right? Let's say in the USA stock market, USA bond market, etc. And you're allowed to do that. There are certain, right, let's say obligations, certain conditions you can follow, and you can invest outside India as well. So whatever investments you have done, if that investment will fetch returns to you, will get income to you, that is investment income that will come into India, and the investment income that will go out of India. Right? So everybody is okay. All these are the examples of transactions under the current account. What about the capital account? Right? Best example for capital account transactions are FDI, FII, etc. FDI, FII, loans taken, loans given, that is inflow of external commercial borrowing, outflow of external commercial borrowing, etc. What is the basic idea? Under the capital account, the money will flow into India, into assets, or it will create liabilities. And the outflow will basically either alter the asset or the liabilities. That is basically the idea associated with the current account and capital account. Everybody is okay with this? Can we go forward now? Right. So we have two accounts, current account and capital account. Now let's enter into the first account, that is the current account. In the current account, please have a look at first component, trade component. That is, let's focus on the exports as well as imports. The exports as well as imports. Now, when you look at exports and imports, you can divide these exports and imports into two components. What are the two components? One is the services and the other one is merchandise. Right? Services and merchandise. Right? And what is the basic idea for services and merchandise? Merchandise refers to goods. Services are invisibles. Services are invisibles. Merchandise refers to goods. So in the current account, there are multiple types of invisibles. For example, remittances, investment income, the income that you earn by exporting services, all these are invisibles. Invisibles means you can't see. Whereas the merchandise, that is a good. Good is a visible, right? Good is visible. Good is tangible in nature. You can, right, basically look at the good. You can define the good in terms of length, width, weight, etc. So focus on the trade component now. Look at exports as well as imports. So there will be exports as well as imports of services as well as merchandise. Now when you look at the exports, specifically focused on services, the value of the service exports is greater than value of service imports. So in this context, that is in the context of the services, you have a surplus. You have a surplus, meaning what? You are earning more money. There is a net inflow of dollars. in the context of services. What about the merchandise? In the context of the merchandise exports are less value or of less value compared to merchandise imports, which essentially means you are having a net outflow of dollars in the context of merchandise trade. Is everybody okay? Please do let me know everybody is okay. So in the context of merchandise, there is a deficit. There is a deficit. In the context of services, there is a surplus. But overall trade, what is the situation in the context of the overall trade? In the context of the overall trade, there is a trade deficit. India experiences a trade deficit. Is everybody okay? And those who are present, I want all of you to keep answering to my question so that I understand that you are understanding. Otherwise, I'll keep on teaching, right? And you may miss out a particular point, miss out a particular concept. If you're missing out, do let me know immediately in the chat section so that I can repeat. Okay, so again, repeating this idea in the context of the trade, the merchandise, there is a deficit. In the services, there is a surplus. But when you look at the overall situation, there is a trade deficit in India. There is a trade deficit in India. Done? Now, what about the current account? When you look at the overall current account, what is the situation? When you look at the overall current account. In the current account also, you can have a balanced current account. Balanced means what? Whether it is in the context of the trade or in the context of the current account, doesn't matter. Balanced means inflow is equal to outflow. Balanced simply means inflow is equal to outflow. So in the current account, you can have a balanced current account. You can have a surplus current account. Surplus means what? Please look at the current account now. Please look at the current account. When you look at the overall current account, if the revenue side is greater than the expenditure side, if you receive $100 and you are paying, let's say, $60 to the rest of the world, that is a current account surplus, right? Basically, overall, you are receiving $40 from the rest of the world. Again, the term overall means net inflow. So there can be a current account surplus. There can be a current account deficit, right? There can be a current account deficit as well. In the context of India, we generally experience the current account deficit, right? That is, the value of outflow of dollars is greater than value of inflow of dollars under the current account. We experience a current account deficit. So there can be surplus, there can be, right, balanced, there can be deficit. India experiences a current account deficit. Everybody is okay, right? So this is the second one. Third one, full balance of payments now. Full balance of payments. That is a complete balance of payments account. You can also do the surplus, balance, etc. for capital account as well. That is, in the context of India, please understand. Generally, we end up having a surplus capital account. We receive a lot of FDI. We receive a lot of FPI, etc. So we end up having a surplus capital account. But when you look at the overall balance of payments, India generally experiences a balance of payment surplus. At least in recent times, India generally experiences a balance of payment surplus. What do you mean by balance of payment surplus? The overall inflow of the dollars either under the current account or the capital account. Overall, right? The overall inflow is greater than the overall outflow of dollars from India. That is basically the situation of BOP surplus. You can have a BOP deficit, you can have a BOP surplus. In the context of India, generally we end up having BOP surplus. If there is a BOP deficit, please listen to me. If there is a BOP deficit, right? In that particular context, the Reserve Bank of India, because there is a deficit, means sufficient dollars are not available. Sufficient dollars are not available. Because the dollars are not available, Reserve Bank of India will conduct sale of official forex reserves. Sale of official forex reserves. So when there is a deficit, sufficient dollars are not there. So what is the option available for Reserve Bank of India? RBI will basically take the forex reserves that it has and it will conduct the sale of official forex reserves in order to see that there are sufficient dollars available in the market. Everybody is okay? Now, there is also one more concept associated with this, that is the BOP crisis. BOP crisis. What is this idea of a BOP crisis? BOP crisis simply refers to the situation where you are exhausting the forex reserves. I repeat, you are exhausting the forex reserves in order to bridge the balance of payments deficits. In order to bridge the BOP deficit, you are exhausting, you are eliminating all the forex reserves that you have. This is called as a BOP crisis. The last time India faced a BOP crisis was back in 1991. And since then, there have been multiple reforms undertaken by Reserve Bank of India, which has added to increased availability of forex reserves. Today, India has forex reserves of more than $700 billion. I repeat, forex reserves of more than $700 billion. And how is it right? How to understand whether this is sufficient or not? How do you understand whether this is sufficient or not? Basically, one way to understand whether this is sufficient or not is to calculate import cover. To calculate import cover, there is something called as import cover. How do I calculate import cover? Take the total value of forex reserves. Take the total value of forex reserves, divide it by the total amount of monthly imports. Divided by total amount of monthly imports. So the amount of imports, if it is, let's say, hypothetically 50 crore rupees or $50 billion, your forex reserves are $700 billion. So $700 billion divided by 50, you will get 14 months. What does it actually mean? With the forex reserves that you are having, you can import 14 months worth of imports. You can import 14 months of imports into India. That is called as an import cover. Right? So right now, according to the economic survey, India has an import cover of more than 11 months. And that's a very, very good number. There is also one more rule, which is called as a Guidetti-Greenspan rule. Right? There is also one more rule, which is called as a Guidetti-Greenspan rule, which basically compares or which states that the amount of forex reserves should be sufficient to take care of short-term debt, short-term external debt. I'll repeat the statement here. The Guidetti-Greenspan rule states that the amount of forex reserves that you're holding should be sufficient to satisfy or take care of the short-term external debt. Right? Do we have sufficient forex reserves to take care of the short-term external debt? And what do you mean by short-term external debt? The debt which will mature in the next 1 year. The debt which will mature in the next 1 year, that is called as a short-term debt. Do we have sufficient the forex reserves? Answer is yes. Answer is yes. In fact, the latest economic survey, right? The latest economic survey says, forget about short-term debt. Take the overall debt. Take the overall debt of India. That is external debt of India. The amount of forex reserve is almost 95% of overall, I repeat, overall external debt. So in the context of the forex reserves, are we in a stable position? Of course, the answer is yes for this. Everybody is okay with the discussion? Please do let me know. Everybody is okay? Can we go forward now? Right, so deficits in the balance of payments, The deficits are taken care of, the current account, the capital account, the BOP deficit, BOP surplus, BOP crisis, etc. Let's go forward. Now, the transactions which are recorded in the balance of payments are generally divided into two types. One is called as autonomous transaction. Second one is accommodating transaction. Autonomous as well as accommodating. What is the basic idea of autonomous as well as accommodating transaction? Autonomous transactions are the transactions which are done in day-to-day operations. That is, these transactions are done irrespective of, I repeat, irrespective of what is the status of balance of payments. These are the transactions which are normally done between one country and the rest of the world, basically to run behind, to earn profits. For example, please tell me now, imports and exports. Right, I'll repeat the statement. Imports and exports. Don't you think these transactions are done irrespective of whether there's a surplus in the BOP or deficit in the BOP? If you are an exporter, will you reduce your export because there is a problem in the balance of payments? Will you reduce your export, right, so that, right, let's say the dollar inflow is reduced, etc.? You will not be worried about what is happening in the BOP. You are worried about your profitability. You're worried about your revenue generation. So I'll repeat it again. Whenever the transactions are conducted, and these transactions are conducted irrespective of the status of the BOP, irrespective of what is happening in the BOP, these transactions are called as autonomous transactions. Most of the transactions in the balance of payments are autonomous. But let's say there is a BOP deficit. Let's say there is a BOP deficit. Now, can I simply say there is a problem in the balance of payments? There is an imbalance in the balance of payment. And what is the imbalance I'm talking about? The outflow of the dollars is greater than the inflow of the dollars. And that's the reason there is a BOP deficit. So in this particular context, don't you think the Reserve Bank of India will conduct a transaction to restore the balance in the BOP? Is my statement clear? What do I mean by restore the balance? You need $100 to go out of India. That is, India needs to pay $100 to the rest of the world. But we have received only $70 this year, which means, can I simply say there is a shortage of $30 in the forex market? There is a shortage of $30 in the forex market. Now, who will supply these particular $30 in the forex market? RBI will take $30 from the forex reserves and supply these particular $30 to the market. And when RBI will supply the $30, can I simply say there is a balance that has been established? $100 are going out of India and $100 are there in the market, that is in the forex market. Right? So this kind of a transaction is done by RBI, not normally, not during the day-to-day operations. It is done only when there is instability, only when there is certain problem in the balance of payments. These kind of transactions are referred to as accommodating transactions. Is it okay? Right? These transactions are referred to as accommodating transactions. So one is autonomous, right, independent of the status in the BOP, and the second one is accommodating, which are done to bring in stabilization, to stabilize the situation in the BOP. Right? So these are the two types of transactions. Let's go forward. How will it do? Which way? My dear, earlier we discussed Reserve Bank of India trying to stabilize exchange rate. How do you think RBI will try to stabilize all of it? RBI is one of the participants in the forex market. Right? All the banks, all the other, right, let's say stakeholders are there in the forex market. RBI will sell $30 and take out rupees. So $30 has been supplied in the forex market, right? Thereby ensuring that existing 70 plus 30, $100 is going out of India, $100 is available in the market. Right? This is generally how RBI will participate. RBI will ensure there is stability. RBI will ensure sufficient dollars are available. Right? So otherwise what will happen? Some of you will be thinking, what if RBI doesn't do this? What if RBI does not participate? What if RBI will not give $30? Then the entity which owes money has to default. Simple. The entity which owes money, money means dollars. The entity which owes dollars doesn't have $30. They will have to default on the payment. That is never good. Right? So RBI will ensure that sufficient dollars are available in the market. Okay, so let's go forward. In the balance of payments, there is one more concept: convertibility. The concept of convertibility. Right? What do you mean by convertibility here? How freely can you convert your domestic currency into a foreign currency and vice versa? I'll repeat the statement. Freely means without any restrictions. Without any restrictions. So how freely can you convert your domestic currency into a foreign currency and vice versa? This is called as convertibility. Now in the context of India, that is a current account and capital account, the government as well as the Reserve Bank of India have allowed free convertibility. I'll explain this. Have allowed free convertibility in the context of current account and in the context of the capital account. Even today, there is a partial convertibility. I'll repeat the statement. In the context of the current account, there is a full convertibility, that is freely convertible. Full convertibility in the context of current account and partial convertibility in the context of capital account. What is the meaning of this? Let me explain. Let's say you will bring dollars into India. You have exported and you have earned $100. Okay, is the example so far clear? I'll repeat it again. You have exported and you have earned $100. Now you have brought in $100 into India. You need to convert the $100 into rupee. If there is absolutely no restriction over the conversion, if Government of India or RBI doesn't impose any kind of a restriction, that is, you can freely convert whatever is the market exchange rate, convert in that particular exchange rate. Using that exchange rate, this is called as full convertibility, or they will simply use the term freely convertible. So the transactions in the current account, I'll repeat the statement, the transactions in the current account are fully convertible. That is, RBI does not impose any kind of a restriction. Whatever is the market determined exchange rate, you can convert domestic currency into foreign, foreign into domestic. It is allowed under current account. And this has been introduced post 1993 in India. Because before that, right after 91, the LPG reforms were implemented. Liberalization, privatization and globalization. With the implementation of LPG reforms, the Reserve Bank of India introduced a mechanism which is called as LERMS, Liberalized Exchange Rate Management System. I'll repeat the statement. After 1991 reforms, before that RBI using a method used to fix the exchange rate. But the LPG reforms, after the LPG reforms, we introduced the concept of LERMS. That is Liberalized Exchange Rate Management System. It is also referred to as Dual Exchange Rate Methodology. I'll repeat this. It is also known as Dual Exchange Rate Methodology. So under this, what Government of India did was, from one type of a system where RBI is fixing the exchange rate to another type where floating exchange rate would be introduced. where the market forces would determine the exchange rate. Rather than suddenly jumping like this from fixed to floating, RBI simply said, let's have certain temporary mechanism which will have a combination of both fixed as well as floating exchange rate, which will have a mixture of both fixed as well as floating. That is the reason this exchange rate LERMS is also known as dual exchange rate. Dual means two. What would happen under the dual exchange rate? Same $100 that you have received because you have exported something, you have received $100, now will be divided into two components. Will be divided into two components. One will be 40% of it. 40% you will have to exchange at notified exchange rate, that is decided by the government. Remaining 60% of the dollars you can convert at market determined exchange rate. That is floating, market determined exchange rate. That mechanism is called as LERMS, was introduced, right, as a temporary mechanism, right, and was later withdrawn. And after that, we introduced a floating exchange rate, complete convertibility, full convertibility in the transactions under the current account. But even today, as we speak, even today, in the capital account, even today under the capital account, we have partial convertibility. We have partial convertibility. Everybody is okay with the concept of full convertibility, the evolution part, etc. Now, what is partial convertibility under the capital account? You are a foreign investor. You have lots and lots of money to invest in India. You'll bring dollars. You want to purchase, let's say, government bonds. You want to purchase corporate bonds. Does RBI allow without any restrictions? Does RBI allow you to invest without any restriction? RBI simply says no. RBI will impose a lot of restrictions on your investments that will come into India under capital account. What is the reason behind it? The reason behind this is very simple. If there are no restrictions, imagine this. If there are no restrictions, there will be a point of time when you will receive lot of inflow of currencies into India. You will receive lot of dollar inflow into India. But if there is any uncertainty, if there is any volatility in the global market, at the same pace, the dollar will flow out of India. The dollar will simply go out of India. That is capital flight. There will be a capital flight which will influence, which will create a lot of volatility in the forex market as well as in the other markets. So there is always a concern that inflow is not a problem, but quick outflow, sudden outflow will always create volatility in the market. In order to address this particular issue, we do not allow full convertibility under the capital account. We allow partial convertibility. We allow partial convertibility. Is everybody okay? In fact, there is a committee report. Remember the name of the committee? SS Tarapore Committee. The SS Tarapore Committee, which was set up long ago by the government of India. In fact, it was set up twice. It has recommended that we must implement full capital account convertibility. We must implement full capital account convertibility. That has been the recommendation of SS Tarapore Committee. But even today, we have not implemented full capital account convertibility. It is partially convertible. Do let me know everybody is okay. Right? These are important things from the balance of payments. We have covered exchange rate. We have covered balance of payments. We'll move on to the next one now. Do let me know. We will move on to the next one. Any doubts so far? Any doubts so far? Okay, great. Let's go forward. WTO, World Trade Organization. Now, what are the important points in the context of World Trade Organization? First and foremost, please understand, there is something called as Bretton Woods Conference. Please have a look at the year. Bretton Woods Conference 1944. This is the time period of the Second World War. Right? This is basically the time period of the Second World War. So the argument of the countries at this point of time was, because of the World War, there has been a disruption in terms of production and supply of goods and services in the global market. That is, a trade disruption has taken place. Many countries are basically involved. Many countries are involved in manipulating their exchange rates. There was also concern associated with infrastructure. Because of the World War, there has been a large scale destruction of infrastructure in the global market. That is the precise reason. What happened was, there is a place called as Bretton Woods. Bretton Woods is name of a place in USA. Remember this. Bretton Woods is a name of a place in USA. So at this particular place, now there was a conference conducted. There was a conference which was conducted, right? And the result of the conference was that the member countries, during the conference, the member countries basically discussed three important organizations. The member countries discussed three important organizations. What were the three important organizations? The first one was International Trade Organization, ITO. Second one was the World Bank. And the third one was International Monetary Fund. Is it okay? International Monetary Fund. So ITO, World Bank, International Monetary Fund. And the objective was also very simple. International Trade Organization will basically address the disruption in the global trade. The World Bank will basically provide financing for development of and reconstruction of, let's say, infrastructure. And the International Monetary Fund will basically focus on, the exchange rate as well as BOP issues. It will focus on exchange rate as well as BOP issues. Everybody is okay, right? Please do let me know. Everybody is okay with this idea? Now the discussions were conducted. The member countries agreed to the second as well as the third organization. The member countries agreed to the second as well as the third organization. That is, World Bank acceptable, the IMF acceptable. There was a consensus. And that is the precise reason we went ahead and set up both of these organizations. And these are essentially called as Bretton Woods Organization or Bretton Woods Twins. Is everybody okay? Why as to these are referred to as a Bretton Woods Twins? Everybody is okay with this background? What happened to International Trade Organization then? There was no consensus. We were not able to arrive at consensus. And because we were not able to arrive at a consensus, International Trade Organization was not accepted. The model was not implemented, right? And as a stopgap measure, that is, as a temporary measure, we agreed to have in place one type of an agreement. We agreed to have one type of an agreement, and that is called as GATT. General Agreement on Tariffs and Trade. General Agreement on Tariffs and Trade. So GATT as a concept, GATT as an agreement was introduced as a stopgap arrangement, as a temporary arrangement. Then over a period of time, there were negotiations conducted. Right? Very famously, these are called as Uruguay round of negotiations. And finally, from 1995, there was an international organization with member countries which was established to promote global trade. And the name that was given was World Trade Organization. World Trade Organization. So this is, in brief, the history that is associated with the IMF, the World Bank, as well as the World Trade Organization. We will cover all the three one by one. Let me start with World Trade Organization. Right? So World Trade Organization was set up in the year 1995, was established in the year 1995. This particular organization, which has multiple countries, which has multiple countries as members, basically focuses on promotion of global trade. The most important objective of WTO is to promote global trade. It is also a forum where negotiations are conducted. That is the trade negotiations, important point. Trade negotiations are conducted where agreements are signed, where there the disputes between the member countries, where the disputes between the member countries are addressed. These are the important functions. Please make a note of these. And when I say note, make a mental note. Don't write it down, because let the class be over. You will get the PDF, whatever PDF I'm using. You will also get short notes on these particular topics. Download, but more importantly, revise. The reason why I'm emphasizing on the trade negotiations is connected to something that is happening in the current affairs. It is something that is associated with current affairs. That is right now, listen to me carefully. Very soon, ministerial conference under WTO will be held. What do you mean by ministerial conference? When you look at the WTO's organization, the highest decision making authority under WTO is the ministerial conference, where the member countries will meet generally, I repeat, generally once every 2 years. The 13th ministerial conference has completed this year. Very soon, we are going to have 14th ministerial conference. We are going to have 14th ministerial conference in Cameroon. And what is the importance of this? The importance is the fact that now the one of the country, that is China, which is being supported by many countries, more than 100 countries, they want to bring in a type of an agreement under WTO, where the focus is on promotion and facilitation of investments. I'll repeat the statement and do let me know, does it make sense to all of you in the chat section or not? Do let me know. China, which is backed by more than 100 countries now, is trying to introduce a kind of an agreement under WTO which focuses on promotion and facilitation of investments, cross-border investments. India is opposed to this. India is opposed to this. Reason behind this is India is saying WTO is not a forum for talking about investments. WTO is a forum where trade promotion has to be done, not the promotion of investments. So this is not the right forum. Hence, we will not support any kind of an introduction of the proposal associated with investment. And this is not the first time that China has tried to do this. Even during the 13th ministerial conference, same thing was tried by China. Now, more than 100 countries are supporting China. Let's wait and see what is going to happen in the 14th ministerial conference. Anyways, come back to the discussion here. The structure of World Trade Organization is that at the highest level, we have a ministerial conference. The ministerial conference generally meets once every 2 years. Right? So now in the 2026, we are going to have the 14th ministerial conference at Cameroon. But the ministerial council cannot keep on meeting every day, cannot keep on taking the day-to-day decisions of WTO. It cannot meet every day. It cannot take care of the day-to-day operations of WTO. So there is one more authority under the ministerial council. That is, the highest authority is ministerial council. There is one more authority, general council. It is the general council which will take care of the day-to-day operations of World Trade Organization. The day-to-day operations. Right? And it is the same general council which will act as the trade policy review body, TPRB, which will review the trade policies of the member countries of the WTO. And it will basically give recommendations as to what changes must be introduced, what kind of policies are hurting global trade, etc. So it will act as a trade policy review body. it will also act as a dispute settlement body. The same General Council will also act as the dispute settlement body. Now, what is this idea of a dispute settlement body? Listen to me very carefully. The dispute settlement body is set up according to the guidelines, or let's say a regulation, a framework, which is known as Dispute Settlement Understanding. DSU, Dispute Settlement Understanding. According to this, let's say there are two countries, X and Y, which are not okay with the trade policy of each other. X is not happy with the trade policy of Y. Y is not okay with the trade policy of X. Now these two countries, it could be two countries, it could be group of countries, doesn't matter. So these two countries will approach the dispute settlement body, DSB. Now the dispute settlement body immediately will not take action, immediately will not swing into action. Rather, the dispute settlement body will ask both of the parties to negotiate with each other, talk to each other, have a mediation, try to resolve the dispute amongst themselves. Is the point clear? It is not immediately going to take action. What is action? I'll tell you in a minute. It will ask the parties in a dispute to try and resolve the dispute amongst themselves. Now, what if this dispute cannot be resolved? In such cases, now the dispute settlement body will set up a panel. It will set up a panel basically consisting of experts who will conduct the investigation. Now the panel will conduct the investigation, submit a report. Now let's say the report simply says the country Y, the policy that they are implementing, the second country, that is country Y, the policy that they are implementing is not correct. It is against the trade policies. It is against the WTO principles. In such cases, the country Y, that is the second country now, can appeal against the report at appellate body, AB, appellate body. It can appeal against the report at one more level, which is called as appellate body. Now, appellate body will look at the report. It will study the report. The appellate body can uphold the report, can reverse the findings of the report, can accept the report. All the powers are there with the appellate body. So once the appellate body will issue the order, now the report will go to the dispute settlement body. The dispute settlement body will vote and basically accept the report. This is generally how the dispute settlement will work. This is generally how the dispute settlement will work under World Trade Organization. Is everybody okay with this? This is how the dispute settlement will operate under World Trade Organization. But right now, the whole process has become dysfunctional. The process of dispute settlement has become dysfunctional. What do you mean by dysfunctional? Dysfunctional basically means, listen to me carefully, in the appellate body, there are 7 members. Appellate body will have 7 members. And these particular 7 members essentially are appointed by WTO member countries. These are appointed by WTO member countries. Now, these particular members will also have a tenure of 4 years. They will have a tenure of 4 years. Now, what is the situation under WTO? The situation under WTO is the appointment of the members to the appellate body has been opposed by USA. Is my statement clear? I'll repeat it again. The appointment of members to the appellate body has been opposed by USA. And please remember this, WTO is a consensus-based organization. It is a consensus-based organization. Meaning what? If you want to appoint somebody in the WTO appellate body, you require acceptance of all the member countries. If even one country opposes it, appointment cannot be done. Same thing in the context of many agreements as well. And that is the precise reason in multiple ministerial conferences. In multiple ministerial conferences, one or the other country has opposed, right? Let's say accepting one or the other provision. As a result of this, those provisions have not been accepted under WTO. So argument is there is a dispute settlement body, but for the whole process to function effectively, efficiently and effectively, you need to have appellate body. But the appellate body right now doesn't have any members. The appellate body right now doesn't have any members. Out of 7, right now 0 members are present in the appellate body. So the whole process of resolving the dispute under WTO has become dysfunctional. Is everybody okay with this? Right? This is the status of dispute settlement body. In addition to this, there are certain important principles. There are certain important principles associated with World Trade Organization. First one, most favored nation. Remember this. Most favored nation. Right? What is the basic idea for most favored nation? Most favored nation principle simply states that when one country will conduct trade means have relations with other countries, trade relations. This is to do with more trade relations, not defense relations, by the way. So when one country is conducting, let's say, trade relations with another country, if this country will extend a benefit to this country, same benefit shall be extended to all the trading partners. Is my point clear? I'll repeat it again. Whatever benefit is extended by one country to another trading partner, same benefit shall be extended to all the other trading partners. This is called as most favored nation. Sir, what is the meaning of it? Right? I'll bring in your favorite product and my favorite product, by the way. Everybody can see I'm holding a packet of biscuit. Okay, let's assume this particular packet of biscuit is imported into India. Hypothetically, I'm saying it is imported into India from country A, country B, and country C. Now, if India will basically impose a tariff of, let's say 5%. Imagine it was imposing a tariff of 5% on all the imports of the biscuit packet into India. If India will extend a benefit to one country, what is the meaning? Instead of 5%, imagine India will impose a 3% tax. India will impose 3% tax. When this product will come from one country into India, that is A to India. Now the most favored nation principle states that the same tariff must be extended to all the other trading partners. That is, the second country will also start exporting this at 3%. The third country will also start exporting this at 3%. Is everybody okay with the idea of a most favored nation principle? But are there exemptions to this? Of course, yes. If countries will sign trade agreement, if countries start providing certain special benefits to poorer countries, etc., in such cases, they are allowed to violate most favored nation principle. But what is the fundamental idea of an MFN, most favored nation? Extension of one benefit to one country not allowed. Same benefit shall be extended to all the trading partners. Right? Another way to look at it is there shall not be any discrimination. Right? I'll repeat it. There shall not be any discrimination. Right? That will be done by one country amongst its trading partners. Non-discriminatory policy, that is MFN. Is it okay? Right? Everybody is okay. Right? And please understand, the most favored nation principle is one of the founding principles of WTO. Otherwise, what will happen is, understand this, developed countries will start trading amongst themselves and they will ensure that developing and least developed countries will not be able to trade with them. I hope you understand why this kind of principle has been introduced. The developed countries, they want to control the trade. They want to become more developed countries. They don't want competitors coming in from the developing countries to them, etc. They will keep on conducting amongst themselves at a favorable, right, let's say tariff, and other countries, right, they will have a very high amount of tariff. So that is the precise reason you are not allowed to discriminate. You are not allowed to discriminate. Done? Right? Most favored nation principle. Second important principle is national treatment. I'll write here only. Second important principle is national treatment. Remember this, national treatment. What is the basic idea of a national treatment? National treatment simply means once the product has been, right, brought into the country, once the product has been imported, the country cannot discriminate between imported product and the domestically produced product. Is my statement clear? There shall not be any discrimination between an imported product as well as a product manufactured in the domestic market. What is the meaning of it? If government of India will implement a policy which will favor only the products manufactured in India, this is not acceptable. This will be considered as violation of WTO principles. And member countries can simply drag India, file a complaint at dispute resolution body, which many countries have done, by the way. Which many countries have done, because you cannot simply promote only the domestically produced goods at the cost of imported goods. That is a discriminatory policy, and you are not allowed to have a discriminatory policy under WTO. That is called as national treatment. Done? That is basically national treatment. And there is also one more, special, right? Special and differential treatment. Special and differential treatment. This is also mentioned in multiple agreements. For example, agreement on agriculture has a special and differential treatment provision. What is special and differential treatment? A developed country can provide certain benefits for developing and least developed countries. Right? The WTO agreements will have special features providing flexibility for developing as well as the least developing countries. Right? So that these particular countries will not be burdened by strict conditions which can be met by developed countries, but developing and least developed countries cannot meet these kind of conditions. So protecting the interest of the least developed countries or developing countries, that is also one of the very important fundamental areas that the WTO focuses upon. Done. So these are certain important points in the context of World Trade Organization. Now, what are the different agreements under WTO? What are the different agreements under WTO? Please have a look at the table here. Let's go one by one. Right, the different different agreements under WTO. Before going forward, some of you are asking questions. Let me address the doubts first. Sir, what about PLI scheme? China has challenged PLI scheme, right, citing many of the provisions of WTO agreement itself. I'm addressing your doubt, by the way. Sandy, I'm addressing your doubt. China has dragged India, challenging multiple provisions, right, of PLI, where it is basically citing agreements under WTO and saying that India is violating these provisions. India is violating the provisions under different agreements. That is, yes, China has challenged it, like I said. Nikki, so how could the USA be imposed a different tariff on countries? How does the most favored nation principle work here? Please understand, most favored nation principle says that there shall not be any discrimination. But listen to me carefully. The countries will use the powers which are associated with the national security. The powers which are given to the respective member countries under national security will be used to mask these kind of, let's say, announcements. For example, what is the reason USA has announced different tariffs? US has claimed national security. Correct? IEEPA, that particular act says that there has to be a national emergency. Right? USA has claimed national emergency, has announced multiple types of tariffs. Although Supreme Court has struck it down, but there are other acts as well. Trade Tariff Act of 1974, under which again, if there is a certain kind of, let's say, situation, USA can investigate, right, and impose the tariffs up to certain time period and maximum up to 15%. So please understand, MFN principle is supposed to be followed by all the countries, correct? But does it mean that countries do not have any kind of other provision that they can use and impose tariffs on the different countries? Yes, they do that. They do that. Can you challenge it? Of course, yes. You can challenge it. But again, what is the status of dispute settlement body? Please look at that as well. China, Russia, many countries have already challenged these particular policies of the USA. But what is the status of the dispute settlement body? Do you think the dispute settlement body without appellate body will be able to provide the complete resolution for the complaint that is filed by many countries? Not possible. Okay, done. Right, so let's go forward now. I've addressed, right, all your doubts, by the way. Let me go forward. Now, let me cover the different WTO agreements and then we can take the break. Okay, then we can take the break. So this is WTO agreements. Now, there are multiple agreements. Let's go one by one. One is GATS. Second one is TRIPS. And the third one is TRIMS. Right, GATS, TRIPS and TRIMS. Are these the only important trade agreements? Absolutely no. Right? There is agreement on agriculture, AOA, that I'll cover in some time. There is also agreement on subsidies and countervailing measures. So multiple trade agreements are there where India is a party. All these agreements are really important for your civil services exams. Let's start. GATS. What does the GATS cover? GATS essentially covers services trade in the international market. General Agreement on Trade in Services. General Agreement on Trade in Services, GATS. Now, what is the importance of a GATS here? Listen to me carefully. The GATS divides the services into 4 categories. I'm repeating the statement. The GATS divides the services into 4 categories. I'm saying 4 categories. It is also called as 4 modes. 4 modes. Right? For example, the service provider, service consumer do not cross the border. Only services will cross the border. For example, education, online education. I'm talking about cross-border, international trade, by the way, not within the domestic market. This is, right, the cross-border supply. In the second case, right, the service consumer will cross the border, go to the country where supplier is present. For example, restaurant services. For example, cab services, hotel services, hospital services, etc. So that is basically, right, a movement. The consumer is crossing the border, going to the service provider. There is a commercial presence as well. That is a mode 3. Under the commercial presence, the company, that is a service provider, will cross the border. I repeat, service provider will cross the border, go to the country where consumer is present and provide services. This is called as commercial presence. This is the third category, or mode 3. And finally, there is also a mode 4. What does the mode 4 cover? Mode 4 covers, right, naturalized movement of naturalized people. That is, people will move from one country to another country. They will provide services when they go to another country. They will join a company, provide services. They will continue to work as a freelancer, continue the services. But what is happening? The person has moved from one country to another country. So generally, all these 4 types of services which are crossing the border, the services which are traded across the border, all of them are covered under GATS. GATS simply says there shall be most favored nation principle applicable on these services. National treatment should be provided to these particular services when they are traded in the global market. right? So that is essentially the concept, the area or the scope of general agreement on trade in services. Then there is right, TRIPS, trade related intellectual property rights. Trade related intellectual property rights. First and foremost, what do you mean by intellectual property? Intellectual property simply means anything that is a creation of mind. I'll repeat the statement. Intellectual property simply means anything that is a creation of a mind. For example, I've created a technology, I've created a design, I've created music. All these are intellectual property rights. And in order to provide protection to the creator, the one who has created these, there will be protection provided. And for this, the member countries are supposed to have individual laws. The member countries are supposed to have, right, let's say acts. Acts mainly means laws in place which will provide protection. That is basically the concept of TRIPS, trade related intellectual property rights. And then there is a TRIMS as well, trade related investment measure, right? A trade related investment measures, TRIMS. TRIMS agreement basically focuses on goods, focuses on investment. It basically says the member countries are not supposed to have a policy which will prohibit flow of investments. You cannot violate national treatment in the context of foreign companies investing in your country. You cannot, right, basically have a discriminatory policy against the foreign investments and have a favorable policy towards the domestic investments. All of these essentially are covered under the concept of TRIMS. Everybody's okay? So TRIPS, TRIMS, as well as GATS. These are certain important trade agreements. Now there is a right agreement on agriculture as well as the subsidies as well as countervailing measures. What is agreement on agriculture? Listen to me carefully. The agreement on agriculture focuses on trade in agriculture commodities, agriculture products or agriculture commodities. Under agreement on agriculture, there are important three pillars. Important pillars. First one is market access. What do you mean by market access? The member countries should not be having barriers. Barriers in the form of tariff as well as non-tariff. There should not be tariff as well as non-tariff barriers. We should minimize them, and the non-tariff barriers should be eliminated, right? Tarification, basically, rather than having non-tariff barriers, have tariff barriers. That is a process of tarification. So there is one, market access, reduce these barriers so that the trade can increase. Then there is right, export subsidy, export support. The countries should not be providing export subsidies, because one which is a developed country then can provide more subsidies, export more and more. Then there is the most important, domestic support. Then there is most important, domestic support. The third pillar, domestic support, important one. What is the idea for domestic support? The member countries are not supposed to provide the subsidies which are going to distort the global trade. That is the global agriculture trade. Right? The subsidies that you provide should not be distorting the global agriculture trade. What do you mean by distorting? Let's take a simple example. What if government of India starts to provide, I repeat, what if government of India starts to provide free electricity, free fertilizer, free insecticide to the farmer? Think of this. What if government of India starts to provide free electricity, free fertilizer, free insecticides to the farmers? So don't you think as a result of all of this, right, essentially the cost of production for the farmer in India will be very, very low. The cost of production will be very low. and they can easily export these agriculture commodities to other markets, including USA, because the cost of production in India is much lower. So these kind of subsidies, which will create a disturbance, which will create a distortion, right, essentially will have to be controlled, will have to be reduced, right? And that is the reason these kind of subsidies, which will create a distortion in the global agriculture trade, are classified under a type of subsidies, that is amber box subsidies. These kind of subsidies, which will create a market distortion, are called as amber box subsidies. Example in India, fertilizer subsidy, MSP, all these are amber box subsidies. So the WTO agreement on agriculture simply says these kind of subsidies will have to be minimized. These kind of subsidies will have to be controlled. Controlled to what extent? The maximum value of the support. They will use a technical term. Please remember all of this. Aggregate measure of support. Aggregate measure of support. The aggregate measure of support cannot be more than 10% of value of production in the context of developing countries. In the context of developing countries, and it cannot be more than 5% of value of production in the context of developed countries. Is everybody okay? This is the limitation. This is the limitation. And it's not that all the subsidies, listen to me carefully, it's not that all the subsidies will distort the market trade. There are certain subsidies. For example, the government of India giving subsidies for development of warehousing. Government of India giving subsidies for R&D in agriculture. Government giving subsidies for pesticide control, etc. These are considered as non-distorting subsidies. These are either not creating any kind of a distortion or creating least negligible amount of distortion. These kind of subsidies are allowed, and these subsidies are classified under green box subsidies. Under green box subsidies. Everybody is okay? So I'll repeat it again. Those subsidies which are distorting the market are kept under amber box. The member countries will have to limit it. The member countries will have to reduce it. Whereas those subsidies which do not create a distortion, these are kept under the green box subsidies. These particular subsidies are not supposed to be, or there is no condition on this, there is no limitation on the green box subsidies. Can we go forward now? Right? Can we go forward? Everybody is okay with this? Please do let me know. Right? So these are basically covered under agreement on agriculture. Right? So in the context of agreement on agriculture, India is basically negotiating. It is against many of the provisions. We want certain, right, let's say relaxations to be provided for the developing countries. That is going to be discussed in the 14th Ministerial Conference. Right? It is going to be discussed again in the 14th Ministerial Conference. Lakshmi, my dear, please don't lose, right? Don't give up hope. Don't worry. Right? Start preparing now. Right? I'm at loss of words. I don't know what to say. I'm at loss of words, to be very frank with you. But all I can say is don't give up hope. Right? Keep on preparing. Next year, you shall ace the examination. Okay, let's go forward. Right, so agreement on agriculture. Next one is SCM. Next one is SCM. Right, what is SCM? Agreement on subsidies and countervailing measures. Let me cover this. After this, we'll take a break. Right, so SCM, agreement on subsidies and countervailing measures. And Lakshmi, my dear, if you need any kind of assistance, feel free to reach out to me. Okay. So agreement on subsidies and countervailing measures. What is this idea of agreement on subsidies and countervailing measures? If a developed country will continue to provide subsidies which are export linked. Right? What do you mean by export linked subsidy? Let's say I'll give you one example. Under the foreign trade policy earlier foreign trade policy, There was a foreign trade policy which was applicable for the year 2015 to 2020. Of course, it was extended later, right? It was extended up to 2023, by the way. So, foreign trade policy, under this, there was one initiative by the name of MEIS, Merchandise Exports from India Scheme. Right? What was the idea of a merchandise exports from India scheme? The government would identify certain exports, and if you're exporting these goods, because it is covering merchandise, if you're exporting these to the external market, then the government would provide certain amount of subsidy which is connected to value of exports, which is connected to value of export. Meaning what? Let's say you're exporting $100 worth of merchandise, government will give you 5% subsidy. Meaning what? You will get $5. If you export to $200, you will get $10 subsidy. If you export, right, let's say $1,000, you will get 5 into 10, right? That is 1,000 into 5%, $50. So here the exports value would determine how much amount of subsidy you are going to connect, you're going to get. These are called as export linked subsidies. But there is one problem with this. There is an agreement under WTO, agreement on subsidies and countervailing measures. India is a signatory. The agreement on subsidies and countervailing measures simply says any country which will achieve a per capita income. I repeat, any country that will achieve a per capita income of $1,000 for 3 consecutive years. I'll repeat the statement. Any country that will achieve a per capita income of $1,000 for 3 consecutive years, such a country is not allowed to provide export linked subsidy. That is agreement on subsidies and countervailing measures. And what happened in the context of India? India's per capita income has crossed more than $1,000 since 2013. Since 2013, it is more than $1,000. So, Government of India announced MEIS, where export linked subsidies were provided. Many countries, example USA, looked at this, dragged India to World Trade Organization, filed a complaint. The dispute, right, resolution started. The panel was set up. The panel investigated. Panel simply said, India is violating WTO norms. India is violating the norms of WTO, the principles of WTO. And finally, the government of India had to withdraw the merchandise exports from India scheme because it is in contravention. It is against the provisions of agreement on subsidies and countervailing measures to which India is a signatory, by the way. Done. So these are the important agreements which are there in the newspaper in the context of World Trade Organization. Again, I'm saying, are these the only agreements? Absolutely no. But these are the most important agreements. Under WTO, there are so many other agreements. Right? So these are the most important ones. Please go through them once more once you get the PPT as well as the handout on this particular session. Everybody is okay with the discussion? Anybody has a doubt or a confusion? Please do let me know now. Anybody has a doubt or a confusion regarding what we have discussed so far? Any confusion? Any issue? Nothing? Okay. Nikki, sir, please let me know where we read about topic of multinational companies. For what purposes? For what purpose? Please clarify for what purposes, because if it is for UPSC examination, I will simply say not required. If it is for, let's say, right, other examination, for example, let's say company secretary, the books for that will be different. Okay, it's right, 1961. Sir, take indices of the India. My dear, what indices you want me to cover? Do let me know. Randy, where do I get the PDF? Let the class be over. You will get the link, right? You will get the official Telegram channel. You will get it in the official Telegram channel. Hemalata, sir, MEIS has been changed to PLI scheme? No. No, right? Both are different. Please don't worry. Right? The PLI is more to do with investment and production in India. MEIS had more to do with promotion of exports in India, from India, not in India, from India. Okay, because there was a specific PYQ on MNC. What kind of specific PYQ? Please don't run behind the concept of MNC just because one question was asked. It could have been asked because in the current affairs, there could be certain discussion. There could be certain discussion. For example, in the 14th Ministerial Conference, there is one agreement that I have not covered here because it will come in the current affairs discussion. There is an agreement ITA, right? There is an agreement ITA, right? That has been signed, right? I'm sorry, it has been signed. And every year, every time the ministerial conference will meet or will be conducted, it has to be renewed. It has to be approved for the extension. So these kind of concepts which are there in the newspaper, based on that, suddenly UPSC can ask a question. But that doesn't mean that you will have to read anything and everything about this concept. Only in that year, because it was relevant, it could be because of that the question has been asked. Okay, done. So let's take a break then. Let's take a break. Time is 6:13. 20 minutes break. Let's restart the session at 6:33 p.m. Let's restart the session at 6:33 p.m. Take a 20 minutes break. I'll restart the session after 20 minutes. Am I audible and visible? Please do let me know. Welcome back. Am I audible and visible? Those present, please give the confirmation. Okay, great. Thanks a lot. Let's continue. Before I go forward, there were a couple of questions. How long will the test go on? I have international trade to cover. Then there is IMF, International Monetary Fund, and then there is right the World Bank. Then essentially there is World Bank. So these are the three topics that I've left out, or that is left out. And first and foremost, listen to me carefully. This is the third session. Right? This is not the second, this is not the first, this is the third session. Before this, I've done two sessions wherein I've covered all the other important topics, right? All the important topics such as banking, the agriculture sector, financial market, inflation, national income, etc. So today is the last session. We are left out with three more topics that might take around 2 hours more, maximum 2 hours more. With that, we will be done with Indian economy marathon sessions. Now, let me start the discussion. International trade. In international trade, what are the important things that you need to understand? First one is the market integration model. The market integration model. Market integration essentially refers to a particular policy where countries, that is the countries, 2 countries, 3 countries, 10 countries, 15 countries, etc., will come together, sign an agreement wherein in this agreement they will provide preferential treatment, that is a discriminatory treatment towards each other. They will provide discriminatory treatment towards each other. That is, let's say, India will sign a trade agreement with another country, for example, UK or USA or New Zealand, UAE, right, Australia, etc. So when India will sign this particular trade agreement, now India will provide certain benefits to the other trading partner, and the other trading partner will reciprocate, will provide benefits to India. So, whatever is the number of countries, 2 countries, 3 countries, or 5 countries within the group, within this particular group, whatever is the number of countries, they will provide discriminatory in favor of each other. They will have discriminatory treatment. Right? So, the benefits will be provided to the member countries within the group, and the other countries which are outside the group, they will not be extended this benefit. This kind of a policy is called as market integration. This framework is called as market integration. Now, how the market integration happens? From the lowest level to the highest level. From the lowest to the highest. The lowest we have preferential trade agreement, where only a small part of the trade, I repeat, only a small part of the trade is covered. That is preferential trade agreement, PTA. Only small part of the trade. When majority part of the trade, majority means 95% of the trade, 99% of the trade, right? So when majority part of the trade is covered, that is called as free trade agreement. India has been signing multiple free trade agreements in recent days. India has negotiated, signed trade agreements with multiple countries, New Zealand, right, UAE, Australia. It is negotiating with USA, etc. So, or European Union for that matter. So, free trade agreement essentially will cover most of the trade, right? PTA, very small part of the trade. FTA, most of the trade. That is a very important distinction. Please remember that, right? Then there is a customs union. What is the meaning of customs union? In the trade agreement, whatever number of countries are present, whatever member countries are present in the trade agreement, now these countries will have common tariffs when they trade with any other country. Is everybody okay? For example, let's say India and Australia. Right now it is an FTA, by the way. India, Australia, they are involved in FTA. But let's assume they will enter into customs union. What does it actually mean? Now, India and Australia will be treated as one entity, one group. Whenever this group will trade with rest of the world, whenever this group will trade with rest of the world, now they will have common tariffs. The best example for this is European Union. European Union, which is a block of countries, when this European Union will trade with any other country, all the countries will act as one unit. They will have common policies, common tariffs when they trade with the rest of the world. Everybody is okay with the customs union. Then there is a common market. What happens in a common market? In the common market, the member countries in the common market essentially will come together. They will have a common currency. They will allow free movement of labor amongst this particular group of countries. That is called as common market. So far so clear, right? And finally, there is an economic union. What happens under economic union? Now this particular grouping now will will essentially, right, have common monetary policy, will have common legislature, will have common central bank, etc. So when the union, that is essentially when this particular group will have, right, a common monetary policy, common fiscal policy, common legislature, common central bank, etc., that is right that is economic union. The best example for this is again European Union. European Union is basically a prime example for all of these. Everybody is okay? I'll repeat it again. PTA, only a small part of the trade is covered. FTA, majority part of the trade is covered. Customs Union, the group will have common tariffs with the rest of the world. Then you have common market, wherein you essentially will have free movement of labor, free movement of investment, etc. And then you have a common currency, you have a common monetary policy, common central bank, a common fiscal policy, etc. That is economic union. Now, in the context of these kinds of agreements, you will also come across SEPA and SECA. Right? Some of you are writing, what is SECA, what is SEPA, etc. Please understand, whenever countries will sign trade agreements, whenever they sign trade agreements, that is FTAs, the focus is on the promotion of trade. The focus is on the promotion of trade, that is exports as well as imports of, right, let's say the goods, right? So trade is the focus. But what if I say these kind of agreements will not just focus on trade, but these are comprehensive in nature. These are comprehensive in nature. What do you mean by comprehensive here? The coverage will be much greater, right, than only covering trade. For example, the agreements will cover investments. The agreement will cover intellectual property right. The agreement will cover movement of labor, etc. So now tell me, can I simply say this particular trade agreement is not just restricted to trade, rather it is much more comprehensive. These kind of trade agreements from one group to another group, when they are entered, from when India will negotiate and enter, they will use different names. They will use sometimes comprehensive economic cooperation agreement. Sometimes they will use comprehensive economic partnership agreement, SEPA, SECA, etc. But fundamental idea is very simple here. These are comprehensive agreements. That is, they go beyond just the trade, right, that is covered in the trade agreement. Is everybody okay? Please do let me know. Everybody is okay? So it is also basically a type of trade agreement only, but this is much more comprehensive. I hope you understand. This is much more comprehensive compared to the other agreements. Okay, right. So these are the various levels of economic integration. Next one, Foreign Trade Policy 2023. Foreign Trade Policy 2023. Right. What is this Foreign Trade Policy 2023? As mentioned earlier, we had a foreign trade policy 2015 to 2020. And please understand, the foreign trade policies have been implemented since very long time ago in India. Initially, this was not called as a foreign trade policy, it was called as EXIM policy. EXIM. EXIM. EXIM policy. Export Import Policy. Export Import Policy. EXIM policy. Right? So initially when the EXIM policies were announced, these were annual policies. Later, Government of India made it as 3-year policies, and then Government of India made it as 5-year policies. So right now, the foreign trade policy, until the most recent one that is being implemented right now from 2023, we had foreign trade policies for 5 years. Now, the foreign trade policy which has been implemented from 2023, it doesn't have a tenure of 5 years. The current foreign trade policy does not have a tenure of 5 years. Please remember that. What is the meaning of it? Unlike the earlier trade policies, there is no expiry date. There is no end date or the due date for the current foreign trade policy. That is a very important point. No sunset clause. Sunset means expiry. So earlier there was an expiry date. Now there is no expiry date. Right? So one, no sunset clause is there currently. Second one, under this particular policy, we have a target of achieving $2 billion worth of exports by 2030. $2 billion worth of exports by 2030. Right? Under this, we want to achieve exports worth 2 trillion, not billion, 2 trillion. Okay. So under this, we want to achieve a target of $2 trillion worth of exports by 2030, $1 trillion worth of merchandise, $1 trillion worth of services. Right now, our total exports have crossed more than $700 billion. Right? So by 2030, we want to achieve a target of $2 trillion worth of exports. Under this, multiple initiatives have been announced. Multiple provisions have been announced. For example, we have now started shifting away from incentivization to system where we are providing remission. Best example is RODTEP. We are targeting districts. Right? DDEH is developing districts as export hubs. So we have started implementing initiatives where individually the districts would be targeted and the districts will be the focus of promotion of exports. We have started implementing ease of doing business measures, etc. So we have implemented multiple reforms under the Foreign Trade Policy 2023 to promote more and more exports from the domestic market to the international market. Everybody is okay with this? Do let me know. Before I go forward to the IMF, please do let me know. Everybody is okay with this? The discussion, everybody is okay? Okay, done. Let's go forward. Next one is International Monetary Fund. Right? What is this International Monetary Fund? As mentioned earlier, IMF is one of the Bretton Woods twins organization. IMF is one of the Bretton Woods twin organization. IMF and World Bank, both of them put together are called as a Bretton Woods twins. Now, what is the importance of International Monetary Fund? The International Monetary Fund is one of the global organizations which will focus on the balance of payment crisis in multiple countries. When the countries face a BOP crisis, it is the IMF which will provide assistance to the member countries. How so? Right? What are the tools? I'll explain it in a minute. Right? But in addition to this, IMF is also an organization which also focuses on the exchange rates, exchange rate policies of the member countries. Because you need to allow the exchange rate to be determined by the market. The governments, whenever they interfere, whenever they intervene, it will create certain problems. It will be leading to, let's say, allegations from one country on another country regarding the manipulation in the currency or the exchange rate. So it also monitors how the member countries are essentially following the exchange rate policies. Are they manipulating? Are they allowing the free forces in the market to determine exchange rate, etc.? So this is the importance of International Monetary Fund. Now, what is the structure of International Monetary Fund? At the highest level, right, we have Board of Governors. At the highest level, we have Board of Governors. Right? So, Board of Governors, every member country of IMF will have two appointees. One is called as the governor and the second one is alternate governor. One is the governor and the second one is alternate governor. Right? So, for example, from India, the Reserve Bank of India's governor will be alternate governor and the finance minister will be the governor. Finance minister, the governor, and right, let's say the RBI governor will be alternate governor. So from each of the member country, this kind of representation will be there in the Board of Governors. The Board of Governors is the highest decision making authority. It is the highest decision making authority. For example, any country that has to be allowed entry into IMF, Board of Governors will decide it. Any country, it has to be removed from the IMF, it will decide. The STRs, I'll come to that, special drawing rights, IMF will decide. The Board of Governors will decide. Right? The change in the articles of association associated with the IMF, it is the Board of Governors. So it is the Board of Governors which is the highest decision-making authority. But the Board of Governors doesn't take care of the day-to-day operations of IMF. It doesn't take care of the day-to-day functions of IMF. For that, there is one more authority to which the Board of Governors will delegate the work. To which the Board of Governors will delegate means allocate work. And that is called as Executive Board. That is Executive Board. In the Executive Board, please understand there are 25 members, 25 directors, and right, let's say the other one is the Executive Director or Chief Director. So there are 25 members in the Executive Board, and it is this particular Executive Board which will generally take the day-to-day decision, or it will take care of the day-to-day operations of IMF. Right? And the appointment to this particular Executive Board, please understand, the member countries now are grouped. The member countries are grouped, are basically put into groups like this. This group will appoint one person as, right, an executive director. For example, from India, this was there in the newspaper very recently, so please remember this. From India, earlier, there was another person appointed as an executive director. There were certain allegations. The government of India terminated, right, the tenure of the the previous executive director in the IMF and appointed another person to replace or function as an executive director. And the new executive director is Mr. Urjit Patel. The new executive director is Mr. Urjit Patel. He has been appointed, and please remember, India is part of the group of countries, that is Bangladesh, Bhutan, India and Sri Lanka. These countries are formed into a group and they will appoint one executive director into the executive board. Right? So these are important points in the context of structure. Then there is a concept of quota. What is the idea of a quota? Quota is nothing but a number. Quota is also referred to as a building block of IMF. Quota is referred to as a building block of IMF. What is quota? Quota is a number which represents position of a country in the global market. It represents what is a position of a country in the global market. That is basically quota. How do you determine a quota of a country? How do you find out what is quota of a country? There is a formula. You don't have to memorize the formula. There is a formula. There are parameters such as a GDP, right? The reserves of the country, right? Etc. There are 4 parameters which are used. And these 4 parameters are used to calculate. It's not arbitrary number. There are 4 parameters which are used to calculate what is quota number of a particular country. And once the quota is determined, for example, in the context of India, the quota number will be just around 2.5. What is the importance of the quota number? Once the quota is determined, it will be used to find out how much is the voting power of individual countries. Because remember this, under WTO, function is on consensus. It is a consensus based, right, framework. Whereas under IMF, it is not a consensus model, rather it is a voting model. Every member country is given certain voting power. And how do you determine the voting power? Quota is used. Right? The number, that is quota, will be used to determine what is the voting power, what is the voting right of individual country. That is one. Second one, how much contribution that each of the country has to do. How much is the contribution that each of the country has to do? Because please understand, every member country has to contribute by the virtue of being a member to the IMF. So the funding, the most important source of the funding for IMF comes in the form of quota. I'll repeat the statement. The most important source of funding for IMF comes in the form of quota, right? So contribution that is done by each of the member country, quota is used. Then there is, right, STR, I'll come to this, special drawing rights. STR or special drawing rights. So the STR or the special drawing rights is also determined, the allocation of STR to each of the member country is determined by quota number. Right? So all these are the important. And fourth important point is, whenever you take a loan, there are different types of loan. Right? There are different types of loan. For example, just observe this. I don't want you to memorize it. Just observe it. There are different types of loan here. Right? There is a rapid credit facility. There is a rapid financing instrument. Right? There is a standby credit facility, standby arrangement, extended credit facility, extended fund facility, etc. These are the different types of loans that IMF will provide. IMF will provide to its member countries. But what is important in this? The importance of this is the fact that these types of loans, the maximum amount you can borrow is determined based on your quota. It is determined based on your quota itself. So different types of loan instruments are there for short-term BOP issue, for long-term BOP issue, for, right, let's say the least developed countries, there are concessional loans. Least developed countries will get concessional loans. Concessional means rate of interest is not there. Whereas for other countries, there are non-concessional loans. That is where rate of interest is charged by the IMF, etc. But how much loan can you take? What is the maximum value of the loan that you are allowed to take? It is determined based on quota. It is determined based on quota itself. Done? Everybody is okay? Right? So this is the importance of the number that is represented, which is called as quota. Now, what are the different sources of funding for IMF? From where does IMF get the funds? Because if the IMF will provide loans, whether concessional, non-concessional, doesn't matter. When the IMF will provide the loans, IMF should have the money. IMF should have the funds. So from where does the IMF get the funds? There are mainly three important sources. One is quota. Right? I've told you already, quota. Right? Quota essentially is a contribution that is done by all the members of IMF. They will have to commit to their quota. But in addition to the quota, there is a second line of defense and the third line of defense. That is, in addition to quota, if IMF requires money, if IMF is falling short of funds, they want money for lending purposes, they don't have that much amount of money, they can borrow under two more instruments, which is called as a multilateral borrowing and bilateral borrowing. Under multilateral and bilateral, what is essentially the argument? There are 40 members under each of them. These members of IMF have promised to the IMF. They have basically guaranteed to the IMF, that is in case of requirement. In case there is a requirement, they will be willing to provide so much amount of money to International Monetary Fund. They will give this amount of loan to the IMF if IMF requires it. Right? So the total amount of resources that are available for the IMF is almost equivalent to 1 billion, right? Almost equivalent to 1 trillion, not billion, 1 trillion STR. Everybody is okay? So these are different sources through which IMF will borrow, IMF will lend. Now, in addition to this, please have a look at this particular structure. Right? At the top, right, the highest decision making body, we have Board of Governors. At the top, that is the highest decision making body, we have Board of Governors. Right? Under the Board of Governors, that is, the Board of Governors doesn't take care of the day-to-day activities of IMF. It has delegated the power to one more authority, that is Executive Board. That is Executive Board. In the Executive Board, like I said, there are 24 members plus one Executive Director. And the Executive Board will essentially take care of the day-to-day activities, the day-to-day operations of International Monetary Fund. But one more very important point, there are two important committees. Memorize this. There are two important committees. One is a Development Committee and the second one is International Monetary and Financial Committee. Development Committee, International Monetary and Financial Committee. The DC as well as IMFC. Right? What is the role of this? These two committees periodically keep on meeting. There are these members in both of them. India is a part of both of them, by the way. India is part of both of them, right? So the committees will keep on meeting periodically and keep on advising the Board of Governors. They'll keep on advising. They can't enforce the decision. They'll keep on advising the Board of Governors. Right? So this is the structure of International Monetary Fund. So far what we have covered, the importance of IMF. Second one is the structure of IMF. Third one is in what way the resources are collected by IMF, in what way the loans are given by IMF. There is one more very important area associated with IMF, that is SDR. Right? SDR. I'll club, there is one more concept. I'll discuss two concepts now. One is SDR, special drawing right. And there is one more concept, that is gold tranche. There is one more concept, gold tranche. Right? Either they will use the term gold tranche or reserve tranche. Okay, gold tranche or reserve tranche. Right? What is STR? What is gold tranche or reserve tranche? Let me start with the second or the latter one. The gold tranche or the reserve tranche essentially means up to 25% of the quota, that is a contribution that you have done to IMF. Up to 25% of this, you can borrow from IMF without paying any charges. Without paying any charges. Without paying any charges to IMF and without coming under any kind of conditions. What do I mean by conditions here? Whenever IMF will provide loans, IMF generally imposes certain conditions on the borrowing country. It will impose conditions. Why? If conditions are not imposed, what is the guarantee the finances of the country which is borrowing money will improve? The finances of the country which is borrowing are going to change. The member country which has already a problem, which has a lot of financial issues, might simply borrow money, might simply take the loan, use it in a profligate manner, might simply borrow money and provide loans, right? Or basically provide subsidies, right? Incur a lot of welfare expenditure. That is not going to improve the financial health of the member country. So what needs to be done? What needs to be done essentially is now there is a requirement of, right, imposing of conditions. But when the member country will use gold tranche or the reserve tranche, under which they will basically borrow money up to 25% of their quota, up to 25%. They do not have to pay any charges. They do not have to abide by any of the conditions of IMF. That is gold tranche or the reserve tranche. Then there is STR, special drawing rights. And all of you, please remember this. When you calculate the forex reserves, when you calculate the forex reserves of a member country, for example, India, what are the components which are taken into consideration in calculation? I'll talk about India. Reserve Bank of India will calculate forex reserves in this way. That is, they will count the most important one, the foreign currency assets. The foreign currency assets, that is FCA. Foreign currency assets is FCA. That is the most important component of forex reserves. Then there is gold reserves. Then there is gold reserves. This is also a very important component, especially in the context of India, the second largest component, by the way. Then there is special drawing rights, STRs, and finally there is gold tranche. Gold tranche or reserve tranche. Gold tranche or reserve tranche. So all the four components put together, you get forex reserves. So far it is clear. So far everybody is okay, right? So this is basically how forex reserves are calculated. Now there is one component that is left out, SDR. What is SDR? Special drawing right. SDR stands for special drawing right. Special drawing right. What is a special drawing right? Please remember this. Special drawing right is the reserve asset. It is the reserve asset that has been created by IMF. It is a reserve asset that has been created by IMF. Right? That is, when IMF will conduct transactions, when IMF will give loans, will recollect the loans, it is done in a form of a reserve asset that has been created by IMF. It has been issued to the member countries by the IMF. That is basically reserve asset. That is special drawing right. Sir, what is this? For example, if you conduct transactions in India, you purchase something, you will have to pay in the form of rupees. You have taken a loan, you will have to repay in the form of rupees. So when you do any kind of a transaction in India, you use an asset that is money in India. In the same way, when you need to conduct transactions with IMF, International Monetary Fund, when you need to conduct transactions with the IMF, essentially now you will be conducting this in the form of a reserve asset that has been created by IMF, that has been allocated by IMF to you, that is special drawing right. Everybody is okay? That's a reason whenever IMF will conduct a transaction, they will mention everything in the form of STR. And how STR value is calculated? There is a basket of currency. There is a basket of currency, right? In the basket of currency, there is a dollar, yuan is there, right? That is renminbi, yuan is there. There is a pound, there is a euro, right? So there is a basket of 5 currencies. You use the basket of 5 currencies to determine the value of 1 unit of STR. And on everyday basis, who will publish what is the value of STR? IMF will calculate and publish what is the value of 1 STR unit. And if I have STR, India has STR by the way, right? And please remember, individuals are not allowed to hold STRs. Private sector companies are not allowed to hold STRs, etc. Only the organizations, IMF, the member countries, these are allowed to hold STRs. So if I have STRs, I can easily convert them into freely convertible currencies such as dollar. I can transfer it to other countries which is mediated by IMF, etc. So this is basically the concept associated with special drawing rights. Right? So with this, we have completed whatever is the let's say important concepts associated with International Monetary Fund. Done? And so please go through the PPT once more. Please go through the PPT once more to revise what we have discussed in today's session. And let me complete the session. Trust me, after the session, I will upload the PPT's PDF on the official Telegram channel. Download it. Okay, the last concept for coverage, that is World Bank Group. Just factual information here. In the World Bank Group, there are no concepts per se. There is no theory, there is no concept, etc. Just factual information. Now, the World Bank Group, please understand, when they use the term World Bank, generally they are referring to these two organizations. That is IBRD, International Bank for Reconstruction and Development, and International Development Association. Generally, they would be referring to these two. But when they use the term World Bank Group, they are referring to all the five organizations. They are referring to all the five organizations. 1, 2, 3, 4, and 5. 1, 2, 3, 4, and 5. And please remember, all these five organizations were not set up simultaneously. They were set up over a period of time, gradually like this. India is a member of all the organizations except one. India is a member of all these organizations except one. That is, India is not a member of International Center for Settlement of Investment Disputes. In short, it will be referred to as ICSID. ICSID. India is a member of 1, 2, 3, 4, but not a member of 5. Reason is simple. There is a convention. I'll give you that point as well. In the PPT it is there. There is a convention. The member countries are supposed to basically are supposed to approve the convention, ratify the convention, and then become a member of this particular ICSID. And this particular entity will take care of international disputes. Government of India historically, I repeat, Government of India historically has been of the viewpoint that whenever there are any kind of disputes, let's say between the government as well as the private sector, the resolution has to be done according to the provisions, according to the laws which are implemented by the respective country. That is, the resolution of the disputes. Resolution of the disputes is a sovereign matter. This has been the viewpoint of Government of India for multiple instances or in multiple, let's say agreements. That is the precise reason India is not a member of the fifth one, but it is a member of the remaining 4. Now, what are the important points? Important points. Because all the 4 will have lot of information. All the 4 authorities will have lot of information. You have to simply go through the important points in all the 5 organizations. One is IBRD. This is the first one, IBRD. IBRD was set up in 1944, the original Bretton Woods. Okay. So it was set up in 1944. It has 189 members, including India, by the way. What is the structure? The highest decision-making authority is a board of governors, but it will just meet periodically. It doesn't take care of the day-to-day activities. Then there is executive directors, which takes care of the day-to-day operations of IBRD. But the importance of IBRD is by looking at the fact that this is the largest development bank in the global market. It is by far the largest development bank in the global market. That is, it focuses on providing loans. Loans to whom? Please remember this. According to the IBRD, let's say the guidelines, it will provide loans, especially for middle income countries as well as low income countries. It will provide loans, it will provide guarantees for the loans which are given to these particular countries, etc. It will provide risk management products, for example, insurance products and advisory services to the middle income as well as low income countries. Middle income as well as low income countries. That's a reason. That's a particular reason why right? Basically it is referred to as the largest development bank in the global market. Largest development bank in the global market. So this is associated with IBRD. Second one is IDA. It was set up in 1960. It will complement the functions of IBRD, right? Why? It focuses on low income countries. This one especially focuses on low income countries. Now somebody will say, but sir, right, the IBRD also focuses on low income countries. The catch there is not not any low income country, only those which are credit worthy. Only those which are credit worthy low income countries. But here, IDA focuses more on low income countries. And what is the role of IDA? Same, provide financial assistance for these particular low income countries. How many members are there in the IDA? 175 member countries are part of IDA. Are the basically they'll say they are the owners of IDA. Next one, there is the third one, IFC. Right? What is the role of IFC? It was set up in the year 1956. It is focused on the private sector, right? It is more focused on private sector in developing countries. Sir, what do you mean by focused on private sector in developing countries? Let me give you one example. I'm pretty sure all of you heard of masala bonds. Those who are present in the session, do let me know. All of you have heard of masala bonds. What is the speciality of a masala bond? These are the bonds which are rupee denominated bonds. These are the bonds which are rupee denominated bonds. Meaning what? When the issuer will issue these bonds, the value of the bond is given in rupees. The issuer will take the money in rupees and will repay the money in rupees. That is the reason it is called as rupee denominated bond or masala bond. But please understand, one of the types of masala bonds that were issued, one such type of masala bonds that were issued is IFC masala bond. IFC masala bond. And what did IFC do with these particular, right, let's say money that was collected, the funds that were collected? IFC used these particular funds to provide loans for commercial entities in India. Right? They issued the loans for commercial enterprises in India for the development of infrastructure. So when you come across the statement, these are focused more on the private sector of the developing countries. Will you be able to understand, make out the meaning of the statement? Right? So this is the role of International Financial Corporation, IFC. Right? There are 184 member countries or members in the IFC. Two more. One is MIGA and the last one is ICSID. As mentioned earlier, I've told you this, India is not a member of ICSID. It was set up in the year 1966. It will basically provide facility for international investment dispute settlement. Can be a potential question in the prelims. Please be very careful. Why? The World Trade Organization dispute settlement body will only provide you the dispute resolution whenever there is a trade dispute. Is my point clear? Whenever there is a trade dispute. If there is a dispute in terms of investment, that is, let's say one country has a dispute with a commercial enterprise regarding taxation, regarding investment, etc., WTO will not handle that. World Trade Organization will never handle that because it is not a dispute associated with the trade. Right? So whenever there is an investment dispute, it is the ICSID under the World Bank which will handle these particular disputes. Right? It has been established with the passage of ICSID convention as mentioned earlier. India has not ratified this convention. Hence, India is not a member of ICSID. Right? How many members are there under this? 165 members. Right? And finally, MIGA, the fourth organization, fourth entity under the World Bank Group, MIGA. Right? It was set up back in the year 1988. And the important functions of MIGA are facilitating right? Basically to promote and facilitate cross-border investment. Cross-border investment, especially in developing countries. It is to facilitate cross-border investment in developing countries. It will provide insurance products. Insurance means, let's say, there is a kind of investment that is being done in a particular country. Obviously, what if there is, right, any kind of a losses in such cases? Is anybody going to provide a kind of insurance for this? Generally, the World Bank Group provides for insurance services for these kind of investments. So provides insurances as well as guarantees for many such projects. And one of the objectives of MIGA is also reduce poverty in the countries. Done? So these are some of the very important, right, functions, important points associated with five institutions under World Bank, which is collectively called as World Bank Group. Right? So with this, we have completed all the things that are relevant from the subject of Indian economy that are needed for the UPSC examination, and focus is more on the static portion in these particular classes. I'm reiterating this. This is the third marathon session. The first two sessions I've covered the remaining topics, and today I've completed, right, the left out topics of the international trade. This is a comprehensive coverage of all the topics from the subject of Indian economy that are needed for the civil services examination. Right. So with this, we have arrived at the end of the discussion for Indian economy. If you have liked the discussion, do not forget to hit the like button. If you are yet to join a YouTube channel, kindly join right now. And at any point of time during the course of the preparation, at any point of time, if you come across any issue, I'm talking about economy, or let's say study strategy, etc. Any issue that you come across, do not hesitate to reach out to me. Right? I'll definitely provide assistance, but ensure that when you reach out and send a mail, please mention that you're writing Prelims 2026 in the subject line, so that I know that you are a priority mail. You are a priority candidate who has to be provided with assistance at the earliest. So, right, so these are certain things. Take care, all of you. Please revise well. Right, if there is any issue, please reach out to me. That's it from my side. Take care. Have a great day. All the best.